So let's get into example. That's kind of the knowledge, the big picture. Now we're going to show you a real example of how it would look if you were getting a captive premium. And I think this really helps explain how they work. It's the part here. So first we're going to talk with the structure. And if you guys are kind of listening and maybe not watching the screen, as I go through this, there's a little bit of animation, which I think helps, just to give you a heads up. I also know that you guys are busy and I totally understand. So what we take these three coverages. We discuss work comp, general liability, and auto. We're essentially going to say, let's take the first $1 million, which means right now, the umbrella you're buying now over your $1 million coverage remains the same. It becomes unchanged. Really going to focus what we call the primary layer, which is the first $1 million. Now, work comp is technically larger than that because it's what's called statutory in most states, but we'll just keep it simple and say just $1 million. So we take those three coverages, we combine them together, and we put them in the group captive you see to the right. And we introduce something called a fronting carrier. A fronting carrier is just an insurance carrier that allows the captive to use their name and their license, and they financially guarantee the captive to your certificate holders, which is very important. Because if you have to present certificates of insurance to whoever to say, hey, I have insurance, we need to make sure, of course, they probably require an A-rated carrier, et cetera, et cetera. So that's what the fronting carrier does for group captives. This could be AIG and Zurich, Old Republic. Major insurance companies have been doing this for years. And so that's a typical way to structure it. So I'm going to take the right-hand side and I'm going to just make it bigger so I can slice and dice it a little bit. And then I added a couple of words. So on a per loss basis, the group captive is going to take $1 million of risk. And what I'm starting with is kind of the theory, and I'm gonna break down what actually happens in group captives. So the group captive would take $1 million per loss. That's a lot. That's too much for a typical middle market company. And so the first thing we do is we slice that. We slice that down. In this case, the example I'm showing today is a $350,000 layer. So now the captive group layer on a per loss basis is just $350,000. And then Zurich, in my example here, is the reinsurance carrier who takes the loss from $350,000 to $1 million. And then again, outside the captive, you have an umbrella if you have a $5 million loss, and it'll all be handled that way. So we're really cutting down our risk on a per loss basis. But then you think, okay, well, Eric, that's a lot. What if we have a lot of $350,000 losses? Okay, let's add another training wheel, another component to really control how much risk we take. And that's called aggregate reinsurance. It's essentially saying at some point in this process, we don't want our members to go bankrupt from their insurance program. So a reinsurance carrier like Zurich or AIG would come in and take over all the claims going there forward up to a certain amount. Now there's this thing I say, skin in the game, and every carrier wants this, and they want to know that at some point, whatever your premium is, that you have to pay more before they will take over. And that's just an incentive to you, to each of the members, to not reach that, because they want you to have a little skin in the game, a little pain before they take over. And that's the way that insurance works in that aspect. So what we've done is we took this $1 million risk for these three coverages, combined them together, and then we brought them down into this bucket where it's your group captive layer. Okay, so that's where the group shares. If you have 20 members in your captive, the 20 members share for that layer. If you have 3 or 4 or 5 share in that layer. But each individual now breaks down even further into what we're going to call the A fund and B fund. I don't know why they originally called the A fund and B fund, but they are. What this is it's a per member fund to help fund for the captive layer. And so each member will have an A fund, in this example, of 100,000. So claims from 0 to 100,000, that's really their responsibility. And then anything above the 100,000 to 350, there's a component of that that's shared with the group. And I go into more detail with that in a few minutes. But do you guys kind of see how, when I talk about the training wheels, when I talk about just making sure there's barriers that doesn't take too much risk to your company while still getting the benefits of self-insurance?
Yeah, Eric, and I think it goes back to a point that you had made at the start regarding some of the myths around captives being, we're not comfortable with taking on that much risk as an organization, kind of that fear of the unknown. What if we do have the bad claims year? But I think what this is highlighting too, especially with that aggregate reinsurance box component, essentially, and I want you to touch on this briefly, a company knows what their maximum spend could be in any particular year based on, what if we did have that bad claims year, and we have the one out of 100 year, and we have a lot of bad claims. You know what your max is going to be regardless.